Hi, this is Attila from Levantine & Co. to discuss tariffs and market volatility with some key personal takeaways and opinions on what we're seeing at the moment. As you all know, President Trump announced sweeping tariffs on what he called Liberation Day to make America wealthy again. Now, these tariffs are substantial, as we all know. We've heard the numbers. China 34%, India 26%, the EU 20%, UK 10%. And of course, these are going to have a significant impact on global trade. The markets have reacted in a way that we haven't seen since 2008 and since COVID. And we've seen a significant sell-off in equity markets, but also in commodity markets. We've seen a sharp fall, for example, in oil, which is trading currently close to $60 a barrel. Now, that said, where do we go from here? Where are we? And how are your portfolios reacting? Now, at Levantine & Co., we aim for significantly diversified portfolios, matching the client's needs. And therefore, for example, if you're in a diversified, balanced portfolio, you should already have a significant amount in fixed income and potentially like assets like gold, which we also have in our balanced portfolios. So now what you might see is that the impact of those alternative assets kicking in, where you're seeing now the fixed income market as a slight pull down in rates, the value of your bonds going up against the fall in the equities. And of course, we're all familiar how well gold has traded over the last few months. If you're in a growth portfolio, again, well-diversified growth portfolio, this is an interesting time, because if you're continuously adding to that portfolio, adding now might be an interesting time because you're bringing down the average cost of your portfolio. Now, that said, what's happening? Well, one thing is clear, that markets don't like the unknown. They create anxiety for investors. And that anxiety is what's pulling markets down. It's not on significantly growth expectations or revised company earnings. We haven't reached that point yet. It's more the shock and awe, as we might say, of what's been announced. Now, I have been working with institutional investors and private clients for close to 26 years now, and have seen such periods over the years, whether in local markets or globally. And one thing for certain, up until now, is markets have recovered. And therefore, the primary takeaway today is steer the course, avoid adjusting positions on the current policies. Staying invested is currently the best thing you can do. Why? For example, look at Trump. We know that he can change his ideas, his thoughts on a dime. Trump is watching Main Street and not Wall Street. But they're both entwined together. US people are invested in their 401ks, which are like their pension schemes. I bet their values have been coming down. And also the business sentiment, the actual environment, the cost of living in the US. Something that I think people didn't give enough attention to recently was, a couple of days ago, I read something on Reuters that Trump's approval ratings were down to 43%. That's in 76 days. That's a very interesting fact. The last four presidents, including Republicans like Bush, typically had above 50, around 55% approval rating at the end of the first 100 days. Obama was at 65. So you can see quite a divergence there. Now, with that in mind, one shouldn't be too surprised if we see a flip of a dime on Trump. It's not a given, but seeing how things are going in the US, we could see him come out with a story of world leaders calling him and begging to sit at the negotiating table, and therefore that he's going to reduce tariffs. Of course, that could have a positive impact on markets. There's something else, though, that in the longer term is a concern that we need to watch. This type of uncertainty reflects on the business environment and investment environment. Now, think of especially business owners in the US. How are they going to feel about making further investments in their maybe manufacturing capacity? Are they going to increase their headcount at work, or are they going to increase inventory? So these type of things are important because they could ultimately trickle down, slowing down of the economy. Coming back finally to where we stand. As a conclusion, we have to wait and see what happens next. There isn't enough information for us to come to a conclusion. But you should be well positioned in a well-diversified portfolio that might include certain geographic areas, for example, China, that is faring slightly better than developed markets. And like I said earlier, fixed income, where you'll see the US 10-year now dipping down to 3.9% yield from previous levels of around 4.3%. And therefore, the value of your portfolio on the fixed income side may be rising. Thank you very much.